In this video clip, we'll go through the Black-Scholes model and verify that it satisfies Put-Call Parity. Now, Put-Call Parity is, in terms of the modern literature, we generally identify Stoll 1969 as the person who teased it out initially and who formalized the relationship. But because it's based on some economic principles and uh, adheres to sort of market equilibrium, um, there is a work from 1688 by De La Vega, so going back 3, 4 centuries before, where while not using the same terms, traced out the relationship between a call type specification and a put type specification in trading contracts of the day. So De La Vega was from a merchant family who had been expelled from Portugal and within 2 or 3 generations had established themselves in Amsterdam and in Holland. And that relationship can be identified back to the Confucians of Confucians. So, but from our perspective, just in terms of implementing Black-Scholes model and verifying it satisfies put-call parity, if we take the classic model and implement using the parameter inputs here, usual notation, stock price, exercise, risk-free rate, dividend yield, sigma, the remaining maturity on the contract, and taking into account the normal cumulative probability, if we set up our libraries by incorporating in Seaborn for graphing and the statistical library SciPy, we can run this Black-Scholes formula. So again, the relationship that we observe here, D1 and D2, align with D1 and D2 formula here, D2 being equal to D1 minus sigma square root of T. And then if we implement the helper function, we can invoke it. Again, let's run that again. Just make sure that all our libraries are here and estimate NP. So I need to import NumPy. So import NumPy as NP. Right, so just put that in, import NumPy as NP. NumPy is a mathematical library and optimized for fast execution, especially for multi-dimensional array operations. So we'll run that again, and then where S is equal to 100, K equal to 100, maturity 1 year, 5%. Risk-free rate, we set the dividend equal to 0 and 0.02. Okay, so then we can go and run again the estimation using the same parameter inputs for the Black-Scholes model. So using the put algorithm helper function that we have here, we can estimate the value of the put, but also verify that if we take the call plus the exercise times E negative RT minus S E negative QT, that the value from put-call parity. So basically, if we estimate the call initially and then take that value and substitute here into the put-call parity relationship and take K and S, when we take the sum of these 3 figures, the value we obtain will be equal to the time value to put, which we can verify in a moment will be consistent with the Black-Scholes model estimate of the put using the same parameter values. So when we run that call, we get 1045. When we run the put estimation from Black-Scholes and verify with put-call parity, that relationship, when we output the tree, the value to call, the value to put from the Black-Scholes model, the value to put from put-call parity, that these two correspond. So when we come down, both are equal to 557. Okay, so again, the relationship is a relatively modern one in the modern literature. It precedes the Black-Scholes model by a couple of years uh, on the basis of no arbitrage and market um, principles. We can identify that the call and the put should align based on put-call parity. Given its the logical thread in the relationship, it probably isn't too surprising that merchants uh, back in the 1600s would have identified such a relationship existed. Okay, so again, no arbitrage would be important here. Um, in terms of identifying the relationship, there is a pricing consistency. And also, if we wanted to create a synthetic put, we could do so using call. So even in the absence of a put trading, the practical implication of put-call parity is we can synthesize a put from a market-traded call option. Okay, let's leave it there.